Hi, I'm Ben from Motivation to Invest. Our mission is to motivate you to invest for your financial freedom. Whether that means escaping the 9-to-5 drudgery or just improving your quality of life, I'm here to help you by providing you with valuable investing tips and strategies. Investing into the stock market can be confusing for many. With so many different financial metrics, it can look like a foreign language or even hieroglyphics. Have you ever been confused by terms which are mentioned on finance programs on the television, such as NASDAQ, FTSE, S&P 500? What do all these terms mean? A friend of mine actually thought the FTSE was something that you do under the table on a date. But if you have ever even been slightly confused by the stock market and all the various terms, then you're not alone. There has been a whole financial institute set up to make things sound very, very complex. Because if things are very complicated, then people are more likely to pay a brokerage service or a firm to invest their money for them, when in fact you can do it yourself. Now, you don't have to know what every single financial metric does. However, knowing a few key terms can give you clarity, which can then boost your confidence and encourage you to invest and make wise decisions. Previously, I did a video on stock market jargon, running over the basic financial metrics which you should know. After that video, I received a flood of messages from people who wished to know about 3 more financial metrics which I didn't mention. So in this video, I'm going to run over these 3 financial metrics which you should know. These are earnings per share, return on equity, and return on assets. Let's dive in. Earnings per share is a metric which describes a public company's profit per outstanding share of stock. This is calculated on a quarterly or annual basis. You can get this number by taking the company's net income and dividing it by the number of shares of stock outstanding. The idea behind this metric is to explain how much profit or loss a company is earning for each share. Return on equity is the net income divided by the shareholders' equity. Return on equity is especially used for comparing the performance of companies in the same industry. As with return on capital, a return on equity is a measure of the management's ability to generate income from the equity available to it. For example, a business that has a high return on equity is more likely to be one that is capable of generating cash internally. For the most part, the higher a company's return on equity compared to its industry, the better. Return on equities between 15 and 20% are generally considered good, but this should be compared to the industry average. Return on assets is a measure of the profitability of the company. Return on assets shows how efficiently a company can convert its investment in assets into profits. From the formula, you can see that return on assets equals net income divided by average total assets. And as a bonus, I'm going to explain asset turnover ratio. The asset turnover ratio measures the efficiency of a company's assets to generate revenue or sales. It compares the dollar amount of sales or revenue to its total assets. For example, if a company has an asset turnover ratio of 5.76, this means that every $1 worth of assets generates $5.76 worth of revenue. In general, the higher the ratio, i.e. the more turns, the better. But whether a particular ratio is good or bad depends on the industry average of which the company operates. As you can see, comparing Apple with Microsoft, Apple with a profit margin of 23.95% times its asset turnover of 1.13 equals a return on assets of 27.06%, which is higher than Microsoft's which has a higher profit margin of 33.1%, times by a lower asset turnover ratio of 0.72. This equals 23.77%. To find out more, I would suggest reading a few investment books, watching some more videos on this channel, and getting some hands-on experience investing. Start with small amounts of investment and then build up. You can even invest from as little as £10 on many of these free trading apps, such as Free Trade or Trading 212. I did a video comparing and contrasting these two apps. Also, if you click the link below, you can get a free share worth up to £100 when you sign up to one of these apps. It would be great to know your thoughts on the metrics mentioned previously. Did you understand the concepts? Are there any that you aren't sure about? Feel free to comment your thoughts below. And if you found this video informative or inspiring, go ahead, smash that like button and definitely subscribe. See you next time.